And AI was also the name of the game overnight following a mixed bag of earnings reports from big tech bellwethers. Four of the Mag 7 names posted earnings, which showed investors whether massive AI investments are translating to sales. Alphabet set the bar high thanks to strong demand for its cloud business, which posted its best quarter of growth since the start of the AI boom. Cloud sales growth at Amazon came in above expectations, jumping 28% for its fastest growth in more than 3 years. Capital spending for the quarter and its sales outlook beat forecasts. As for Microsoft, it posted a modest rise in quarterly cloud growth, its shares recovering from an early fall in after-hours trade as capital spending came in lower than expected. And Facebook owner Meta posted its fastest quarter of growth since 2021. While the company is yet to produce new revenue streams from AI, the technology has boosted its advertising business. Shares fell in extended trade after its capital expenditures came in below expectations and user growth disappointed. For more, we're joined by Gil Luria, who's head of technology research at D.A. Davidson Companies. So, Gil, thanks for your time today. So, just looking across, Meta, Alphabet, Amazon, Microsoft, we see an increase in capital expenditure on AI infrastructure. What is it telling you? I mean, is this going to be the new normal? Is more spending expected? What about, concerns that this spending might actually possibly be structurally inefficient?
Yes, we would expect the capital expenditures to continue to grow. In fact, Microsoft already guided that the second half of the year would be substantially over the first half. Meta increased its CapEx guidance. So did Google. A lot of that, to be fair, is higher component costs. Memory costs especially are much higher. The memory chips are significantly more expensive than they used to be. You mentioned Samsung's benefiting from that. Companies like SK Hynix and Micron are benefiting from that. But yes, these companies are getting a good return on that investment already. We know that because they all have accelerating growth at stable margins. So they're growing their operating income very significantly, and that's because of these investments. And so they made it very clear that they intend to continue to invest at least at this rate. And if anything, they need to invest more because component prices are so much higher.
Yeah, and your cloud infrastructure, there was also the center of the AI boom, featured quite prominently in the results. Do you see it as a primary source of monetization going forward, rather than, say, the AI models itself?
Yes, they're generating a lot of revenue because of the AI models. Anthropic and OpenAI use a lot of resources from Microsoft, Amazon, and Google has its own models that it delivers. But all these companies are also selling AI compute to enterprise customers as well. Microsoft, Amazon, and Google have all the enterprise customers. So when a company wants to use AI, they're not only paying OpenAI or Anthropic for the model, they're also paying for the compute within these hyperscalers. That's why these companies have accelerating growth at healthy margins. That's why they are seeing the return on investment that's encouraging them to continue to invest.
Yeah, I want to zoom in on Amazon and OpenAI's partnership. Now, I mean, what extent does this partnership kind of strengthen AWS's competitiveness versus, the one that OpenAI has with Azure, which, of course, Microsoft already has deep integration with OpenAI, but they've now severed that exclusive tie-up.
Yes, this levels the playing field for OpenAI with Anthropic. Anthropic has had tremendous success selling into the enterprises because they were selling across AWS, GCP, and Microsoft Azure, while OpenAI was mostly selling through Azure. Now it's a level playing field. OpenAI can participate with AWS customers, with Google customers, and therefore can catch up to Anthropic that's developed a little bit of a lead in enterprise AI. So it was very important for OpenAI to make a new deal with Microsoft and to increase its involvement, especially with AWS, who is the largest cloud provider.
Yeah, and now I'm going to go to Meta. So it signaled hundreds of billions of dollars in long-term AI investment. But from the way investors are reacting, I mean, there's probably some concern there, some hesitation there about monetization. What do you think is missing from Meta's AI plans and its strategy? And I mean, as a consumer myself, Meta's AI model, for one, is also significantly lags those by, say, OpenAI, Anthropic, Google, Gemini, for example.
Well, that's right. But for now, Meta's AI capabilities are helping it sell more ads. You pointed this out earlier. Their growth was 29% on a constant currency basis. That was an acceleration, and it's massive share gains within the digital advertising market. It's because they're getting so good at delivering ads and charging more for them. So they are getting that return, but their investment is well above and beyond that. And that's what investors are reacting to. It's these comments that, yes, we'll continue to grow revenue nicely, but we're going to grow operating expenses even more. We're going to grow CapEx even more. That puts pressure on margins. That's what investors are reacting to. Having said that, we've gone through these waves of pushback from investors, and Meta's reacted with cost cuts. At the end of the day, Meta's growth will translate to higher profits, and their investment in AI will either translate to success in AI or they can cut back on that investment. So we're very comfortable with Meta. They're making a big bet, but it's a calculated bet.
Okay, and this is also coming as Meta's announced sweeping layoffs recently. I mean, how are you viewing this against its latest earnings report? Do these moves meaningfully kind of offset the AI spending in your assessment, or is this largely just symbolic, trying to reassure investors?
Oh, it's absolutely to offset AI spending. The more you build data centers, the more depreciation you take for building all the data centers. If you don't cut down on headcount, then you won't be able to maintain your margins. So Meta has to continuously manage down its headcount in order to be able to spend on AI. But part of it is self-reinforcing. The better you get at AI, the more productive your people are, the less people you need to execute the same task. So it's both of those things happening at Meta, and soon we'll see that in many other technology companies.
All right, Gil, we appreciate your time today. Gil, you're the head of technology research, D.A. Davidson Companies.